Lyn, welcome back to Real Vision. It's the first time you and I have actually sat down to chat, so I'm really looking forward to it.
Yeah, nice to have me, and it's great to meet you.
Can you give people a bit of background about yourself, just so those who aren't familiar with you know a bit more about you?
Yeah, sure. My background blends kind of engineering and finance. So I've been investing since I was really young, but my career path started out in engineering. And then I gradually shifted more towards kind of engineering management and engineering the managing the finances of an engineering facility, while shifting more and more into applying that kind of quantitative background to finance investing. So that's kind of how I approach things in a pretty quantitative way.
And so what do you do now exactly?
So I run LynAlden.com, which is a research firm. So I have a free newsletter, and then I have a paid service that it's kind of it has a blend of kind of high net worth retail investors like retirees, and then all the way up to the professional investors. So kind of a lot of it kind of takes some of the complex kind of macro topics that might be more covered in institutional research, and then distills them for a broader audience. That's kind of the main focus.
So how did you get into macro to start with? Where out of engineering, which is a detailed discipline process, into macro, which is a broader process? Why did that happen?
It was a gradual transition because so I actually started more in individual stock analysis, and I still do that because I feel like the bottom up analysis and the top down analysis, they help inform each other. So sometimes the bottom level analysis can inform my view of the top as well. But I started out in individual stocks. But over the years, I realized that we're in a very macro-heavy environment. It's kind of, I refer to it as the end of a long-term debt cycle, or fourth turning. You can kind of call it different ways. Kind of a large kind of transition, and so I realized that the individual stock analysis is only capturing a part of the picture, and that I really have to look at macro and to kind of move assets around kind of big recessions and things like that, and get the general directions of asset classes right.
So when you made that transition, you have to come up with a macro framework. Where did your framework come from? What was the genesis of it? And then how did it develop over time?
So a lot of it actually, in my view, comes from control engineering. So my engineering discipline is mostly controls analysis. So it's kind of like managing a system that has hundreds of inputs and outputs, and figuring out the relationships and making sure, kind of for every action, there's like a opposite reaction. So if you think of like, say, a thermostat as a simple control system, if the temperature goes up, it kicks in and it reduces the temperature. So a control system is like that, but there are hundreds of variables instead of just one or two. And so I realized essentially that macro is one big input output machine essentially, and there's all these reactions that can happen to it. And then there's policy responses that push things back down and have then ripple effects downstream. So a lot of it is essentially kind of looking at things from a control systems framework into macro, and using some of the same kind of quantitative background to kind of apply it in that space.
So when I approach macro, I approach it in terms of secular cycles and the business cycle. How do you approach it in terms of, what is your kind of basic framework of how you look at it?
Similar way. So I monitor a lot of economic indicators in rate of change terms to see how things are changing before we get into an actual contraction in some ways, or before we get to an expansion. So that's kind of the business cycle analysis. And then I use a lot of historical data research to kind of figure out what are the major turning points where something can act a lot differently than a normal business cycle. And so, for example, in this environment, I was in kind of this weird phase for the past couple of years because I've been bearish from a business cycle perspective, thinking.
Sorry for interrupting your video, but I have an important message to share. At Real Vision, we pride ourselves on providing the very best in-depth expert analysis available to help you understand the complex world of finance, business, and the global economy. So if you like what you see on Real Vision's YouTube channel, that is just the tip of an iceberg. You should come over to realvision.com and see how we are not leaving any stone unturned, from publishing more in-depth videos, live discussions, written reports, and our latest feature, The Exchange, where you get a chance to engage with experts and fellow subscribers and learn from everyone's experience. It is an experience which you live and you learn from. So if you go to the link in the description or go to realvision.com, it costs you just $1. I don't think you can afford to be without it.
Normal business cycle. And so, for example, in this environment, I was in kind of this weird phase for the past couple of years because I've been bearish from a business cycle perspective, thinking we're late in the business cycle, things are expensive, but also still being somewhat more bullish than I would otherwise be on equity, and risk assets, which played out pretty well so far because I expected such a large fiscal response this time, and that was informed by a lot of the longer term stuff, seeing kind of how close we are to the zero bound, how the Fed's going to be somewhat limited, and then it's really going to be a more fiscal environment. And long-term debt cycles often get resolved with just partially with very large fiscal responses and some degree of currency devaluation. So I've been using that as my framework to kind of augment how I think this cycle can play out compared to say the past two cycles or so.
So I obviously I look at the same things, and one of the things that puzzles me is why do the actions of the Fed affect the US asset markets, while the actions of the ECB, the SMB, the BOE, and the BOJ don't really affect their asset markets in the same way in terms of risk appetite? Why do you think that mechanism is? Because it's weird, right? Because the ECB can do as much as they want, and it won't drive the Euro stocks up and down.
Yeah.
But is it just a reaction function or a behavioral function or Pavlovian or what?
I think it could be behavioral. I think there's a couple if you separate out the top 5 or 6 stocks from the U.S. equity market and just look at how the other 490 some stocks behave, they look in some ways more like the Euro stock index, right? So they've been flat-ish for the past decade or so, whereas the top 5, 6, 7 stocks have really kind of lifted the whole index. So if you kind of separate those like super companies out, there's less of a difference in some ways. And then also kind of a general thing I've just observed is that global real estate in many places is even more expensive than U.S. real estate. A lot of foreign investors focus more heavily on real estate, and the U.S. has just always had these really big, deep capital markets, and there's more of a global emphasis on the U.S. equity market. And so I think our relationship between real estate and equity is a little bit more equity focused than a lot of other places. That's kind of the.
There used to be a lovely thing people used to talk about that made total sense. My whole career, people just said, listen, concentrate on one thing. The Fed run the monetary system for the equity market, and the Bundesbank run it for the bond market. And when you understood that, that was just a great trade. Well, sorry, everybody. I don't know what's happening. This is why the US needs an infrastructure bill at some point. Because they are in New Jersey, and I've got a better internet here in Little Cayman than you've got, which is quite bizarre. So we were talking about how the Fed run monetary policy for the equity market in the US, and the Bundesbank ran it for the bond market. And that's always been a truism. They just look at things in different ways. So I just find it interesting that, therefore, if it's a behavioral function, is it robust, or is that a fragile assumption that gets tested?
I think it's very fragile. I think this big equity run was in some ways expected, but for example, it went further than I would have guessed a few months ago. So my base case for a while is that March bottom was a pretty resilient bottom, and that we probably weren't going to see that for a while. But I didn't necessarily expect to reach all-time highs back in the S&P 500 here in August. So it came up a lot faster than I would have thought. I would have expected more chop and maybe more sideways consolidation for a while. Even if we didn't see that lower low. So I think it's potentially quite fragile. And there can always be just a few quarters of just worse economic data than people think. And this whole everything the Fed's doing could kind of just be unwound to some extent. And I think one of my base cases is the Fed's mostly now out of ammo by itself, and it's more about fiscal at this point. So whether or not we get fiscal and how much and what kind of areas it's in kind of affects my view of macro more than anything the Fed does now. And the Fed's job will be to monetize some of that fiscal, but it's really more about the fiscal things, because the Fed can't do almost anything about the solvency issues, whereas the fiscal spending can do some things about the solvency issues. And I think that's going to be the bigger role going forward, is fiscal.
Yeah, so as you know, my base case is that we're going to get into a solvency problem because GDP growth is probably going to stay negative for a longer period of time than people expect. And solvency builds on itself. It creates more job losses. And slower growth. What's your view on the solvency situation going forwards?
Yeah, similar. I had a piece a few months ago called First Liquidity and then Solvency. So,
Which
the
is exactly what I had.
yeah. Yeah, the liquidity thing was back in March and April, and then we got that out of the way, and I think that's pretty under control now. I think the Fed is kind of vigilant, so we see a pretty fast response time, but there should be more liquidity shocks. But solvency still has a lot to play out. I mean, we've seen a lot of the job losses turn permanent. And I think that's probably going to continue. I think there's we've seen the kind of the service sector shut off and then start to rebound. So we had that rebound in some areas, but I still think we have a normal credit cycle to play out, and probably more than normal because it's bigger than normal. So I still think we have kind of the more kind of white collar job losses, or the more kind of professional job losses that were not necessarily directly tied to service sector kind of pandemic stuff. So I still think this has a long way to go, and there's not much the Fed can do about that. So it kind of comes down to how much the fiscal authorities want to let that solvency event play out, or how much they try to intervene.
But the question is how, because of, I think you alluded to at the beginning, is the size of the debt cycle here. Sure, the Fed are backstopping corporate bonds. I mean, it's crazy. They're buying Microsoft bonds and stuff like that. But there's the whole middle rump of all of this that is an issue, because there's debt, there's lower revenue streams.
Yeah.
And so what you've got is a potential insolvency. Insolvencies tend to go slowly and then pick up over time.
Yeah.
I don't know what size government response can deal with that. They can do it for short periods, but how do you backstop a system for 6 months or 9 months or a year?
I think they do it in bursts, and I think that we're going to kind of have these bottlenecks where for a while they don't do it, and then some of the market signals or some of the civil unrest are their signals that force them to do another round. So, for example, back in March, we got this, roughly $3 trillion in stimulus. So we have a weird case. If you look at all the economic indicators, GDP is down, employment's down, exports and imports are down, industrial production is down, construction's okay, and then retail sales are up at all-time highs. And that's because personal income is actually back. It's higher than it was when the year started, because the people that didn't even lose their jobs got those stimulus checks, and the people that lost their job, a good percentage of them actually made more money with all the offsets, all the extra unemployment benefits. But that all kind of came to an end, at the end of July. So now we're kind of off this fiscal cliff, and the market's still kind of going up like Wile E. Coyote. So I think the big question in the next couple of months is whether or not we get
Coyote market. I like it.
Yeah. So the big question is whether or not we get this big fiscal thing that they're talking about, or if that gets gridlocked for months. So my base case is that because it's an election year, they're likely to pass something and kind of kick the can down the road for another few months at a time. But in this market, it's really hard to look more than a few months ahead, because it really all comes down to the next round of fiscal. And I view it as kind of bouncing back and forth between either they're doing fiscal and markets are reacting okay, and we get kind of probably more currency weakness on one hand, or when they kind of pull back with the fiscal, we can kind of see a slowdown in some of those indicators. But then, I think it's kind of like how, for example, Powell back in 2018 was on autopilot with tightening until the market kind of crashed in Q4, and it made him change his tune. I think that's kind of how fiscal can play out, where as long as the stock market is doing well, and there's not a lot of stress, policymakers will delay things. But then when you have kind of a market sell-offs, or you have kind of a rise in civil unrest, it spurs them into action again. I think we could see this dynamic kind of go back and forth for a little while.
And that was much the same with QE 1, 2, 3. They were, the Fed would do QE, step back, the markets would unsettle, or the economy would unsettle, they'd come back again.
Yeah, I think we're going to see a similar thing, except with fiscal more so than Fed action.
So one of the things I've been thinking about fiscal, I mean, I totally agree with you, but at some point, there's chances of something much larger coming.
Yeah.
Because if let's say they have a couple of shots at fiscal and it kind of just inflates for a bit, falls again, kind of Japan style, then there's a chance that they're going to say, fine, we're going to do a 5 trillion, X trillion, New Deal style spend, and it'll be different depending whether it's on the left or the right. What do you, and that's kind of, I think, closer to the end game when they start to do something absolutely enormous. What are your thoughts on how this kind of fiscal evolves?
I agree completely. So I think that's why my longer term view is a more reflationary environment and a trend shift from this past 4 decades of disinflation to a more inflationary environment. And I think that's because if you look at their incentive structure, the main kind of limiter on how much fiscal they do, while keeping, using yield curve control and other tools to keep yields low, the eventual, kind of risk to that is inflation, and like unmistakable consumer price inflation. So
where do you get that from? That's what I understand that there is a probability of it, but in a slow growth environment with an aging population, I don't know how to generate inflation because we've never seen it elsewhere either.
Yeah, so just going back to that point, I think their incentive structure is essentially that basically, as long as there's no inflation, then the big question anyone can ask is why not print more money? Because if they print $3 trillion and all it does is good things, from as far as people can tell, people, small businesses were going to go out of business, and then they got, a PPP loan that gets forgiven, or people got 600 extra a week, they got more money from not working than working, or just as much. People got stimulus checks in addition to their normal working, and so they think, okay, why not do it again? If there's no downside to printing money, why not print more? And of course, as long as they print money and there's no kind of outright inflation, it seems like there's no consequence. And if you look back in the previous crisis, the consequence of that money printing was, kind of an increase in wealth inequality over time. It didn't really affect the root issue. But that's because it wasn't really fiscally driven. It was just central bank kind of recapitalizing banks, propping up the wealth effect. Whereas this is more direct to economy stimulus that gets mostly monetized. And so, with that, when they do it, it feels really good. And literally the only limiter at that point is inflation. So as long as they don't see inflation, it's really hard for them to say, okay, we did all that, there was no consequences, but we're going to stop now. So I think we're kind of in that environment where, when we see weaker growth, the question becomes louder, like, why not do more? And then they do more, and then they say, okay, that's enough, and they pull back, and then we see a more disinflationary environment again, and the people say, why not do more? And I think that kind of repeats until they kind of get the genie out of the bottle a little bit. That's my base case.
Yeah, I'm still not sure that inflation genie comes out. The market's expectation of inflation genie might come out, and maybe you're right. But I've just noticed in the past, going through 2001, 2008, fiscal stimulus didn't generate anything longer than 2 quarters of some sort of growth, and it didn't really. People don't think of it as a perpetual state, and therefore earnings expectations, etc., don't rise.
Yeah.
And consumer behavior doesn't change because they think of it as an emergency measure. Therefore, they hoard the capital as opposed to spending it. And we saw that a lot in Japan. They just couldn't get fiscal to really. They built tons of new stuff, didn't really work. So, I'm not sure that plays out. But the fiscal is going to be a big deal. What do you see in terms of? Okay, by the election, there's going to be 2 very different fiscal stimuluses. If it's the Republicans or the Democrats, talk us through the 2 different scenarios that you're thinking through.
Yeah, so it's interesting because a lot of people's big question is who wins, whereas my question is more about how decisively whoever wins. Because let's say you get a Biden victory, but the Senate is still red, right? Then I think we're in a situation that looks a lot like the Obama presidency, where the last 6 years of it, where you had kind of that gridlock between what Obama wanted to do and what the Senate wanted to do. And so if you get, say, a blue sweep, I think we're going to obviously be in a very spendy environment. If you get, a pretty strong red hold, I think we could still see a pretty strong spending environment because Trump's going to want to spend. And, if the House stays blue, they're still going to want to spend. And there's going to be some disagreement there between what they spend on, like we're seeing right now. Whereas if you get kind of that more gridlock scenario, I think that's when you get kind of a longer period until they do more spending. And I think you could have more of a disinflationary environment, or at least an elevated risk of that happening. So for me, there's definitely different flavors the spending will take depending on who wins. But my biggest question right now is kind of how decisive and how kind of gridlocked the result is versus if there's a sweep.
Yeah, and it's interesting because you can actually see markets pricing in some of this, because there's also other things that we can tell is most likely a Democrat victory would see more regulation of oil companies, more regulation of tech companies, and a few other key areas. And some of that's being priced in. It seems to be coming a little bit out now as maybe the spread between Biden and Trump diminishes. What would be the winners in kind of sector terms on a Trump victory for you?
I think that could be stronger for the equity market than a Biden victory. just because I think if a Biden victory happens, you could see kind of pricing in of higher corporate taxes in general. I think you're right about kind of the tech regulation. I don't see a very strong kind of sector difference necessarily between who wins. It's more about the overall magnitude. A chart that I've been showing is that if you look at effective corporate tax rates, so not just the headline rate, but the actual kind of, a couple of different ways to calculate it, but the effective payment rate, that's been kind of steadily declining for decades. And so even when there's not a headline change, there's still other changes that keep pushing that rate down. And I think we're, that number, the effective version of it is somewhere in the 10% range for the federal side. And so I think we're kind of getting to a lower bound probably for corporate tax rates. And so this very long kind of secular bull market we've had has been an environment of perpetually lower and lower effective corporate tax rates. And I think that could, either flatline in some cases, or it could reverse, and we could get higher effective corporate tax rates. And I think that's something that could pressure equity markets kind of throughout the 2020s decade. Of course, the odds for that increase if you get a Biden victory.
Yeah, so we're now getting closer to approaching this election period and the period of no stimulus. Does that make you more nervous on the equity market? Do you want to hedge downside, or do you want to trade the downside? How are you thinking of the equity market in this particular moment?
Yeah, so I de-risked a little bit in June, and I've been kind of holding that steady. And I have been contemplating de-risking a little bit further now because this fiscal gridlock is currently in place. And I think, as I've been saying, that because my outlook is pretty fiscal heavy, the big question is if we get those fiscal holdups, I do think we risk more and more seeing kind of pullbacks in some risk assets. So we've been seeing really bad breadth in the market. So it's only a handful of winners that have really driven this market up. And I think that's at risk of setting up some downside if there's not more fiscal. So for me, it's less about, say, virus headlines or about these kind of one-time things, and more about whether or not they throw another $1 trillion or $2 trillion at things, or if that gets delayed.
And what would be something that would be to make you think there's more risk? Because if, for what you're saying is, things could fall, it goes back up again, things could fall as new fiscal. What could change that or make it a more risk environment? Because if not, it's pretty benign. It's just more volatile.
Yeah. Well, I think risk of increased taxation is definitely something that could pressure equities pretty heavily. I think obviously an increase in the China-U.S. tensions could add a lot of downside volatility. And my base case for equity markets over the whole 2020s decade is to be pretty poor, especially in real terms, let alone nominal, depending on what inflation does, depending on who ends up being right about the level of inflation we get throughout the whole decade. But at least I think the safe answer is in real terms, I expect pretty poor equity performance. And so whether or not we get a really bearish outcome, I think is up in the air, but I think the upside is not great, even long term.
So then, so the equity market, and I agree, it's not a great trade for a longer term time horizon. Doesn't seem that's a particularly good trade.
Yeah.
What about the bond market? Sounds like you're going to be more negative. My view is bond yields probably have another stab lower, and then the trade's over, but I doubt we get bond yields rising because either the Fed stop it or the disinflationary trend stays. What's your view on bonds?
I agree. My base case is that even if we were to rise, the Fed will cap yields. So that's been a big piece of my work lately, and they've already been openly talking about potentially doing that. So it's all on the table out for everyone to see. So we've had we had the big March spike. So we had bond yields go down tremendously. Your trade worked out very well. So from that low level during that really illiquid portion, we had kind of the whole treasury market become a liquid. Yield spiked very briefly. The Fed came in with a liquidity hammer and took $1 trillion of treasuries off the market in 3 weeks and hammered that spike back down. Then we've been in this like sideways period. We had a little bit of a treasury spike in June, but the market just brought that rate down by itself. And lately, the past week or so, we've been in this rising. We had another yield spike here. It seems to be back on the downtrend, but it's unclear at the moment. So my case is essentially that there's not a lot of range for bonds because sure, we could have another deflationary shock. We could have one of those risk-off events that I talked about potentially spurring them to do more fiscal. So we could have, say, a lower low in bonds. We hit the zero bound perhaps. So there's not a ton of room there. And if they go up, which I think they might try to do when we get a more inflationary environment, if that outcome works out, I do think they cap it.
And
so
that's
I think,
more likely 2021 than it is 2020.
Yeah. And so, I think they could it's possible they could lay the groundwork for yield curve control later because it's a way to give forward guidance, but I don't think they're going to have to do kind of hard yield curve control in 2020 because this is, still playing out. So I think the bond trade is pretty weak at this point. And one of the big things I'm watching, which is curious, I'm actually be curious to hear your thoughts on too, is that we've had a divergence between break evens and nominals. So if you look back over the past, 15 plus years of data, there's only ever been one period where we had break evens trades, so far above nominals, and that was in about a year from 2012 to 2013. So if you look at this period, nominal yields came down and they've stayed low in this range, whereas break evens, after they hit that March low, they popped right back up. So the Treasury's pricing at higher inflation, or at least a rebound in inflation, not necessarily higher inflation, but a rebound in inflation, and yet they're still keeping nominals low. So that's kind of one of the things I've been watching, which has been very interesting. I'm not sure if you have thoughts on that.
Well, it depends who the bar is. So we saw this in the UK, I don't know, 20 years ago, and it was the pension system. Because the pension system had long-term liabilities, they were forcing apart the relationship between break-even and nominals.
Yeah.
In hedging that out. So I don't know whether it's just flows driven as opposed to a signaling. So in the UK, the signaling became useless in the end. I think the signaling for inflation ended up being better in the nominals than it did in the break-evens because of flow into break-evens, which are obviously less liquid. You tend to, if the whole pension system decides that we're going to an inflationary environment over the next 10 years and with the pension liabilities that they've got, they probably need to buy break-evens regardless of whether inflation goes up or not. They need that hedge because if not, they're super bankrupt. They're bankrupt now and then they're super bankrupt later. So it's possibly that. Don't really know. And so the other thing I'm thinking about, we've gone through equities, which don't look like great forward expected returns. You're kind of keeping on to some risk for the time being because fiscal could keep it okay. Bonds, they could probably drift lower in yields, but no great trade there. Credit, we both think there's a solvency event in the making. I watch the price every day of AT&T and General Electric and all these big triple Bs, and the equities go down, but the credit is never going to go down because of the Fed.
Yeah.
I mean, have we lost the credit market now as well? Are we going to lose the bond market at kind of zero bound? We lose the credit market because of the Fed.
I think so. I don't know if you saw news the other day. The New York Metro was selling bonds, to raise some capital, and banks gave them a bunch of bids, and the market priced it, and they turned around and said, no, we don't like any of those yields, so they sold it to the Fed for a lower yield. So that was one of the more blatant cases of just the market had a price, and they had price discovery, and then the Fed's just, we don't like that number. We're in some ways we're seeing yield curve control in these these riskier markets, not yet in the treasury market.
I mean, the ECB did that. I mean, the ECB have done that for almost a decade now.
Yeah, and then they use those like negative yields to go buy out other companies, and it creates all sorts of weird behavior in the market. So I think that the most of that market is not correctly pricing in risk to some extent because the Fed is kind of handicapping it. So
my view on that is it's not going to, because the Fed are not going to allow it to happen because it blows up the pension system if it does happen. So the equity market probably has to price in that credit risk. And we've seen that now. The banks have massively underperformed, the indices, and the triple B sectors massively underperformed in equity terms. So I think it may be the equity market prices that in.
Yeah, I think it's possible. And that's why, I still use some individual stock selection to augment my risk exposure rather than rely on indices. So I can identify companies that I think have, longer positive term outlooks, that have kind of the strongest balance sheets at least in their industry, if not, either in absolute terms or strongest in their industry. And so that's one way to minimize risk if people are kind of willing to go down to the individual stock level. Whereas just from a broad indice level, it's really challenging.
So, moving on to asset classes. Now, we know your view on the dollar, so we've seen that, and the dollar's relatively weak. But where is the opportunity going forwards? Because we've identified, the three main other asset classes kind of going nowhere. So where do you see the opportunities?
I see a couple. So, to get some out of the way, I think emerging markets have some opportunities throughout the 2020s. I think it really depends on the market. So instead of just being one market, it's a collection of so many different markets, like Russia and India and Turkey couldn't be more different. So, I kind of analyze each country differently. So I have like a report that kind of goes over like 30 different countries and just kind of sees what the macro situation's doing. So I do think there are some opportunities in some of these equity markets that have not done well over the past decade. That are trading at pretty reasonable valuations, and that some of the ones have stronger fundamentals, like say less dollar-denominated debt as a percentage of GDP, that sort of thing. So I think we could see some opportunity there. I think after international diversification has mostly worsened returns over the past decade, I think it could increase returns over the next decade.
The emerging markets have massively underperformed. This is the second largest underperformance in all history.
Yeah.
So at some point over the next 10 years, once the dollar fully turns, whenever that is, it seems like it's a bit of a no-brainer as long as you can get rid of the debt issues that are still out there.
Yeah, I think so. And if you look at the big period of underperformance, it made sense because back in 2007, emerging markets got extraordinarily expensive. Like India's CAPE ratio was the same as like the US and the dot-com bubble. Like you hit almost dot-com bubble like valuations in China, India, to some extent Brazil. So that's kind of worked itself out. Equity valuations have come down, even though there's still been an increase in some earnings and GDP growth in those areas. So now we're at kind of healthier valuation levels. So if you do get more of a turn, there's more of a base to work up from compared to working up from very high valuation. So I think that's it's pretty rare for an equity market to do well in one decade and then still do well in the next decade. So so the U.S. has dominated this decade, and now I think we've squeezed a lot of juice out of that orange, and I think that at least some of the stronger emerging markets have decent opportunities over the 2020s. I am somewhat bullish on copper. I think you see it the other way, but so copper.
Well, I had a trade on, and I actually stopped out the other day because I got bored of the trade, but because at the time I was thinking copper in the, I think I put it on during the liquidity phase, and it was the only short commodity position I had on because I'm relatively bearish over time, industrial commodities, because I think there's more disinflation to come before we might see a shift. So other than that, so I don't have a massive view on copper.
Yeah, so some of those base commodities, if we get the more reflationary outcome, I'd be pretty bullish on those. We're at a pretty kind of big divergence between commodities underperformance compared to equities. So I do think we could see somewhat of a rebound there in time if we're looking over multiple years. And then besides those those are more of my like risk areas, like the emerging markets and the base commodities. And then precious metals have been one of my key trades since 2018. Both the gold, silver, and the gold miners, some of the silver miners as well. So that's been a very kind of a useful trade so far. It's getting a little bit harder now because we have come pretty far, and now the real rates has mostly played out. So now it's highly dependent on getting a reflationary outcome and having yield curve control to keep kind of real rates low. So I think that
I'm not convinced about the real rates thing. And let me talk you through my thought process, because I think it will align with yours. And I think the market just says real rates low, gold up, right?
Yeah.
But from what I can tell, we're going to get deflation, headline deflation for a period of time, just mathematically. And real rates will likely rise. I think they go, really quite positive, a bit more positive than people expect. And people say, well, okay, that would be negative gold. But I think about it and think, okay, so you're the Federal Reserve and you see real rates rise sharply because inflation is lower than people expected. Their reaction function is just to do more.
Yeah, exactly.
So therefore, gold goes up. It's it seems it's only corrective as opposed to a trend change if real rates change.
Yeah, that's how I view it. And this last, kind of correction we've had, gold and silver came very far, very fast. And then we did see that kind of bottom form in the real rates. We saw like an increase in real rates. And this time it happened to be because nominals rose, faster than CPI rose. So it was the opposite direction. But we saw that pressure on precious metals, but it seems to have been corrective because the long-term fundamentals still support precious metals to some extent because, if we're not going to get rates out of bonds, right? So if you look back in history, there is a pretty strong relationship between real rates and year-over-year changes in gold prices. However, it's not perfect, of course. There's other factors that influence it. And so in those environments where you can get a strong positive real yield on, bank accounts or treasuries, there's a big opportunity cost for holding gold. Whereas in this current environment, there's no kind of real yield happening in the whole treasury space or in bank accounts. And so it makes the opportunity cost for holding gold much lower. Plus, we're seeing other, countries around the world, like central banks, have been shifting more of their assets a little bit into gold over time because they take away that counterparty risk, they take away the sanction risk, they kind of de-dollarize a little bit. We've seen more out of things like Russia and Kazakhstan and, to some extent China. So I do think that gold still has pretty strong legs, even if real rates are choppy for a while. Like I think you phrased it correctly, they're more corrective rather than kind of major trend changes. Because we're going to, as soon as you see that, you see more money printing and more kind of stimulus.
So how do you see silver versus gold? Because, they're not the same thing. How do you see the difference and why are you favoring silver? I'm long silver as well, but I'm just interested in your view.
Yeah, so now I'm more mixed. So I was, for a while, gold was outperforming. It tends to do better than silver in those more disinflationary environments. So real yields were falling since 2018, but it was not because CPI was rising. It was the opposite. It's because nominals and CPI were coming down, and nominals were coming down faster. So gold tends to do well in that sort of kind of risk-off disinflationary environment, where silver tends to do better in a more reflationary environment. So that's what we've seen so far, where we had gold outperform until the March crash, and then we've had silver come up strong since then. Now, because the gold-silver ratio has normalized a little bit. I think that trades harder now, because when silver was extraordinarily cheap relative to gold, and then we had this trend shift towards reflation, I think silver was easy for anyone who's patient and can handle the volatility, isn't leveraged to it or something like that. Whereas now, now I'm more mixed. Now we've had some of that kind of normalization. So now I don't have a strong opinion between the two, and I like to have both for diversification because they can move on somewhat different forces.
And if there is more volatility around fiscal stimulus, stuff like that, so reflation on, reflation off, reflation on, reflation off, it's likely that silver's more volatile then. I mean, it's more volatile anyway, but it kind of feels like gold probably is better anchored.
Yeah, and I think it can make for good rebalancing to kind of, extract gains out of that choppiness, or more active trading around that choppiness, kind of selling overbought conditions and buying oversold conditions. So yeah, I think both of them have pretty good prospects throughout the decade. So I think they have a somewhat upward bias, but I think you can get a lot of money kind of trading around that bias.
And you like gold miners as well.
Yeah, they've come pretty far pretty fast. So I still like them. I like them less than I liked them in 2018. But I still, compared to say the S&P 500, I still like having a segment of gold miners in my portfolio. Not a big one, because kind of like silver, the volatility is pretty high. So I manage that volatility with position sizing. But yes, I'm still fairly bullish on precious metal miners.
So what are you really bullish on?
Well, for the next year or so, probably Bitcoin.
I knew I was waiting for that
yeah. Well, because in the past couple of years, my highest conviction view was the precious metals, and I had no position in Bitcoin. And I analyzed it in 2017, and I didn't have a position, and I was skeptical about some things about it. So I wasn't strongly bearish, but I just wasn't. I was kind of leaning bearish a little bit. But in April of this year, I turned bullish. And then in May and June, that just got even stronger, just bullish conviction. Basically, where we are in the halving cycle, and how kind of uncorrelated Bitcoin is to other things. If you look at the Bitcoin log chart and compare it to the halving points, it's clearly operating on its own cycle. So for me, that's a more isolated trade. Where for gold and silver, I have to take into account that whole kind of fiscal reflation, off-on situation. Whereas Bitcoin, I think, is going to be, I think around the margins, things like liquidity and reflation on or off can affect some of the the daily, weekly, monthly action. But I think that the price difference between now and say the end of 2021 is not going to be strongly influenced by other factors. It's mostly influenced by how much Bitcoin demand there is compared to the reduced supply. So I think that's at least when managing position sizes, I think that's one of the easiest kind of asymmetric trades at this current time, where it's not guaranteed, but the upside is so many more times than the downside.
Yeah, and that's how I see it. I mean, it's almost I can't see any trade that comes close, even kind of volatility adjusted, right now for this period ahead. As you say, the year, 18 months ahead, it just feels like it's the superior trade. Gold had that run, Bitcoin, consolidated for a long period of time. We had the halving. It kind of, and we've had a lot of regulatory changes in the US that allows banks to custody it, which means basically that's code word for we can prime broker Bitcoin for hedge funds.
Yeah, and we've seen kind of the institutional access build out, right? So it's easier for institutions to access it now. We've seen Paul Tudor Jones kind of come forward and kind of open the floodgates a little bit, potentially for more institutional money. And the ecosystem around Bitcoin just gets stronger with each halving cycle. So there's more companies kind of making it easier for retail to access it, and institutionals can access it, like you point out pretty well. And also we've seen kind of a rise in Robinhood trading this year. And they can buy Bitcoin right on the app. So if some of that kind of, instead of buying bankrupt companies, they can switch over to the cryptos and have a blast with that. So
yeah, and we've seen Davey Day Trader is now is now become a crypto guy because bizarrely it's because it's not regulated by the SEC as much. So he can basically pump it up. I don't really know how to think that through, but I can understand that retail money is going to come back into it along with institutional. And one of the things that I think about, and you probably think the same way, is it's one of the biggest legitimate front-running opportunities I've ever seen, because you kind of know where the herd has to go, which is all the institutions. And the more it goes up in price, the bigger the market cap is, the more they have to do it.
Yeah, the more it gets hard to ignore. And so far from the halving cycles, that's kind of the general trend is the supply gets cut in half, the new supply gets cut in half, there's still demand for it. So that starts kind of pushing up price. And then when it pushes up price enough, you get the momentum traders in there. And then, that pushes it up even more. And then you get the FOMO traders. And so it's, I think, a really asymmetric bet to just say, okay, we're in the early stage of a halving cycle. It's possible this halving cycle doesn't play out anything like the other ones, and it just totally flops. Or just to say, okay, I have a specific time frame. I'm willing to risk a specific percentage of my capital to see how this plays out for a year and a half, and just see if that same pattern happens. And because demand is still strong, and because there are more institutional access points, I don't have a strong case as to why it wouldn't be kind of a similar price shape as the previous.
It's pretty reflexive right now because we're all set up for it. Yeah. We know what's coming. We know that the flow of funds are coming, and we know how retail's going to react with it. So it's almost a potential self-fulfilling prophecy. As you say, there's no guarantee here, but it's as good a quality trade as I can see anyway right now.
Yeah, I think the risk reward's just very good, especially when someone manages their position sizing and they have a specific kind of time frame.
And do you look at Ethereum yet, or just mainly Bitcoin?
I've looked at a bunch of them, and my approach is to stick with purely Bitcoin. For this cycle, at least, I'm specifically bullish on Bitcoin. I know you've gotten into both. I don't know if you had any updates on Ethereum.
Not really. I mean, Ethereum for me is a bet on the system, and Bitcoin is a bet on the reserve asset itself.
Yeah.
So, and it's like gold, silver. I think, Ethereum was underpriced versus Bitcoin, and no stronger view than that. Really, like you, my core view is Bitcoin, but I'm just trading around it because I think there's more opportunities in Ethereum. And, I'm looking at buying in as it's been correcting in the last few days. And I just think, there's no real reason if retail gets sucked in that it's not going to go up further because it's slightly more speculative. Here's something interesting I saw yesterday on Twitter. If you saw it, somebody put the Bitcoin dominance over the altcoins, i.e. how much of the total market cap of the entire kind of crypto universe Bitcoin has versus the US dollar.
I actually did see that. Yeah. I haven't dug into it. I'm wondering if it's kind of a random correlation or if it's actually somewhat causal. Yeah.
I don't know. It struck me, and I looked at it, and it's very similar if you look at the Ethereum Bitcoin cross rate against the DXY, and that would be the same, I guess, as the gold silver cross rate. So there's some informational value I've not yet processed within that.
Yeah, it's interesting. I keep trying to find correlations like that. When I was doing research for Bitcoin, I was always trying to figure out, say, are there certain liquidity indicators that correlate really well with it? Is it how much of a liquidity play is it? And it really wasn't until I saw, kind of the log chart and the halving cycle, that was the clearest, like, unmistakable pattern.
What is so great as an asset is doesn't correlate over longer terms, as you say. So it's hugely accretive to a portfolio.
Yeah. Yeah, especially if you kind of pay attention to the halving cycle and it just operates on its own beat pretty much. And there's still like brief periods where correlations go to 1. So for example, its price was definitely influenced in March by the broader macro picture, but that was a blip on the radar. Whereas the year-long outcome is mostly just operating on its own beat.
And so you're more bullish on Bitcoin than you are on precious right now?
Yeah, over the next year and a half at least. I think over this period we've seen very strong price action in the precious metals. I remain bullish. I just think the easier part of the trade is finished, and now it's the harder part of the trade, which I'm willing to stick with. But I've also been hedging the difficulty of that by just having a Bitcoin position, because I think, ironically, at least for this specific year and a half, I think it's the easier trade.
Right, I'm going to ask you some questions that we've got from our audience about a lot of things we've been talking about. So here's a question again about Bitcoin is, how do you see Bitcoin performing in another risk-off event?
I think it could be like March, where I think we could have a blip. I think we could have a down. I'd be a buyer of that. I think that'd be corrective. So again, in the grand scheme of managing position size, so not going kind of maybe overboard with it. But if we get that kind of pullback, I would use that as a chance to probably accumulate more. I think it has strong correlations to liquidity in the very near term. So if we have a sharp liquidity issue, I do think you could see a pullback, but I don't think that changes, say, the price, where the price ends up in late January 2020 or late 2021.
It's kind of like gold as well. Gold has short-term liquidity issues because it's quality collateral, right? So you liquidate your quality collateral to pay for other things. So of course it gets hit, but it doesn't last long.
I agree. That's how I view it.
When we're talking about emerging markets, which ones do you favor looking forwards? I mean, right now it's probably still a bit of a mix in emerging markets. Nobody's doing anything specific, but if you're looking forward to that longer term time horizon, what are the emerging markets that you kind of favor or think you favor at this point?
Yeah, so I like India for the most part. Now I've actually been surprised at how weak they've performed in this period so far. They're one of the few countries where COVID cases are still rising very quickly, and some of their economic data has been weaker than I would have guessed. So that I think that still takes time to play out. But I'm pretty bullish. Say if you look looking back at the end of the decade, which equity markets did well, I think India has a good case for doing well. Its valuations, it's always one of the more expensive markets because, the demographic, the demographics are great. The debt levels are pretty low. They're not one of those countries that have a ton of dollar-denominated debt. Their currency tends to be weak because they have to import a lot of oil, so they kind of burn these consistent trade deficits. But I do think that valuation-wise, even though it's not cheap, it's compared to its long-term history. It's not like it was in 2007. It's not in bubble territory. I think it's considering the growth and the demographics and the balance sheet. I do think that that's a pretty strong equity market over the long term. On the opposite end of the spectrum, I actually like Russia. It's slow growth, but it's super cheap. It's been cheap for a while, but it's still cheap. And they went into this crisis with a fiscal surplus, a trade surplus, very low debt, more reserves than external debt. And they have the highest, say, gold to M2 ratio, pretty much of any major country. So they have tons of gold. They just have tons of reserves. A lot of it's gold based. It's really obviously dependent on oil prices. And so to some extent, I like to combine that with my India trade. So because India prefers lower commodity prices, Russia prefers high commodity prices. And besides those two factors, I like them both long term here. So having them both in a portfolio kind of takes out some of that commodity question to some extent. And kind of which one does better, I think, will depend a lot on commodity prices. I like some of the Chinese tech stocks. I like Tencent, for example. Now, China is a black box to some extent. You can't. It's not a trade I like too much, but especially when you look at, say, an emerging markets ETF, one of the problems is that China dominates it. So it's like something like 40% China. So that's actually one reason I like to diversify away from the broad emerging market ETFs and use some single country exposure to, say, get more Russia, more India, things like that. But I do think China at current valuations, especially for some of their companies that aren't, because China, of course, has that really large corporate debt problem. but it's not. It's a lot of it's in the real estate sector, so you don't really see it in companies like Tencent. So I do think kind of a selective Chinese exposure, kind of take into account that the numbers, could be are made up. So I think kind of whatever position you would have, just have less of it. So if the fundamentals look good, discount it by the fact that there's a question about how real those fundamentals are. So,
and you might as well call that the superpower basket: China, India, Russia.
Yeah, superpower basket. I think Latin America is pretty pressured. I've had some selective stocks down there, but I'm more selective on individual names rather than indices. I think some of the other countries in Asia, I mean, South Korea, MSCI still considers an emerging market, but they have better internet than I have. So,
Yeah, I don't know. Somebody's got to reclassify all that stuff. I mean, Taiwan and South Korea are not emerging markets.
Yeah. Oh, FTSE considers South Korea developed. So if you look at, say, a Vanguard Emerging Markets Index, South Korea is not there. Whereas in the iShares MSCI, that's where you have Korea in there. So yeah, I don't consider it emerging, but if we're going to call it that, I think it has some promise. So yeah, they're the countries that I'm kind of favoring.
Right, some more questions. So somebody's actually asking, flipping back to the crypto and gold, so Lyn has mentioned in the past she thinks about her precious metals investment in terms of liquidity layers, from physical to ETFs, with physical being the last layer. Does she think about Bitcoin in the same fashion, cold storage to the Bitcoin trust? What price would she exit her respective Bitcoin layers?
Oh yeah, that's actually
follows you very closely.
That's a really good question. Yeah. So yeah, for people that aren't aware, I've described my precious metals exposure as layers. So I have physical layer, which I'd be very slow to sell. The only time I ever sold physical was 2011, and part of that was luck. But so I don't really trade that. Whereas then I have the miners, some ETFs. I prefer some of the harder ETFs like Sprott funds or Perth Mint rather than the GLD, but it's still liquid. So for my purposes. I'd be quicker to sell some of those liquid positions. Now, bringing that to the crypto space, I do have a similar approach. So I have a layer of that in cold storage, which I would be slow to sell. I'm not even sure I would sell it in this halving cycle, for example. Whereas I have then a more liquid layer that my plan is to kind of taper some of that out if we see price action in this halving cycle that's anywhere near like the previous halving cycle. So if we see that kind of pretty sharp rise in 2021, instead of trying to time the top exactly, I probably would start layering out some of that liquid position. Whereas cold storage position, it'd have to get pretty crazy for me to kind of dig into that and release that. But I think I could trim it in this cycle. I don't really plan on going to a zero Bitcoin position, so I don't plan on fully loading that kind of lower layer.
Another question on gold and silver. Well, beyond gold and silver, specifically platinum, which has been consolidating for some time, and copper. We talked a little bit about copper. So your views on those?
So I don't follow the platinum market as closely. I followed it to some extent. I am somewhat bullish on it. I have a little bit of platinum exposure. But it's a much smaller position compared to gold and silver because I have a long history of tracking gold and silver. In some ways, they were essentially my first investment. So I have a very long history of keeping up with those markets. Whereas platinum is more kind of industrial based, and it's almost like I have as like a tail position in case there's some shortage or in case we switch back more towards using platinum in some industry. So for me, it's kind of it's a slight diversifier on my precious metals position rather than kind of a core thesis.
And copper.
Yeah, so as we discussed, I'm pretty bullish copper long term. There hasn't been a lot of new development. Now it's very dependent on China's consumption because China is responsible for like half of copper. So that's kind of the big tail risk is China's a black box. So what happens with their copper demand? I do think going back to India, I do think India could be a pretty big source of copper demand in the 2020s. They have a much smaller copper installed base per capita than China. And even China, even despite all its infrastructure, they have less copper per capita installed than the Western countries. So I do think I'm pretty bullish on copper for the 2020s, but it is, there's risk related to, especially to China.
Yeah, and I'm the same with India. Look, I'm half Indian. I spend a lot of time there. and they've got a lot of building to do.
Yeah.
And, I think if anybody's going to drive the next commodity super cycle, you need a demand side of the equation. It's certainly not going to come out of the West. Yeah, sure, we might get an infrastructure bill in the US and Europe, but really it has to be India. There's nobody else that can move the dial enough to do that.
I agree. Yeah, I view it as so. I think because of how impactful. Again, bringing it back to the long-term debt cycle, in addition to this whole COVID-19 hit, I think that in the 2020s, some of these Western countries are going to turn to more infrastructure to try to kind of prop up their economies. And for example, the electrical grid in the U.S. needs much bigger upgrades if it's going to support more electrical vehicles and things like that. So I do think that can drive some marginal demand for copper. But yeah, I think India is kind of the saving grace for copper. And then some degree to some degrees other emerging markets, but I think India is kind of the headline there for driving copper. And then the other side of it is there's not a ton of new supply at current prices. Like there's more supply they could bring online at higher prices, but at current prices, it's not really incentivized to bring any new supply online. And there's actually been pretty significant exploration costs, and they're still just not finding a ton of copper. So I think that it's kind of almost an inevitable situation, but the timing is there's multiple years of variance there for how long that trade takes to play out. So I like having some copper exposure.
Okay, final question is, what would cause you to change your mind on precious metals? When would you say, right, I need to get out, trade's done?
I think essentially if we get kind of almost like a good thing, like if we get kind of a blow off top in precious metals. So I was getting a little nervous when it was starting to go vertical in the past month. Now we've had some corrective action. I've identified, a time that I would probably sell a lot of my liquid position would be if we get a more reflationary trade. They do yield curve control. Real yields go, more negative, and we get kind of a blow off top in precious metals. Then I'm kind of out of catalysts for the near term for why I should still hold it. So I probably would reduce my liquid exposure. On the other side, there's not a ton that would make me want to get out of it, because most of the things that would be bearish for precious metals, say like we get higher real yields, more disinflation, deflation, we could see consolidations in the precious metals, but I think equities could be worse, right? So between bonds, equities, I always kind of view it as what does gold and silver replace in the portfolio? Like what would I put in there if not for them? So I don't really see equities or bonds doing much better over a multi-year period than them, especially equities. So there's not a ton that would make me kind of sell it on the bear side. That's kind of my answer. Yeah.
Yeah. I thought this through myself recently. I thought, in what scenario would I want to get out of gold? And yes, like you, if it goes up, excess speculation, of course. The other one would be 1.5% to 2% GDP growth and 1.5% inflation. That's kind of low volatility, okay world. It's just not good world for gold.
Yeah, no, I think
either tail is fantastic. Gold, I think, has got a smile to it, somewhat like the dollar has a smile to it. Gold's got a smile to it, and somewhere in the middle, in that kind of Goldilocks economy, it's not great for gold.
I agree. Yeah, I think it's kind of an intermediate thing where I think there could be a year or so in here where we get years like that. They're just gold is just dead for a year. So that's my concern on the bear side is not necessarily like a big kind of bear cycle for gold, but more just like a bad year here and there, and kind of trying to manage the risk of that happening.
Yeah, essentially we got it from 2011 to 2018, really.
Yeah.
And what that was, in the big picture, it was just a sideways correction. Sure, it was quite a big range, but really it was just a sideways correction. Gold did its thing because there was kind of less monetary largesse around, et cetera, and gold kind of just rested. And then as soon as things pick up again, then gold does its thing. Yeah.
And I have a model that kind of tracks gold price relative to money supply growth and interest rates. And so if you look back in 1980 and 2011, it got way ahead of the model. Whereas in this period, it's not really ahead of the model like it was back then. So, it would have to run a little bit further for me to say, I think it's overvalued. I think it's dangerous. But I do think if we get a more Goldilocks period, I think, it won't be, I would be surprised to see a big kind of multi-year bear market consolidation, but I do think we could see a smaller, year, 2 year, just kind of slumpy period for gold because it's just there's nothing driving it in that year.
One thing I do is I've got a basket of 27 currencies versus gold, and that's super interesting because it does exactly what you'd imagine it should do. It offsets all the currency weakening of these 27 currencies. We've lost Lyn again. So I think we will call it a day. Thank Lyn, everybody. And hopefully if there's any other questions, put them in the comment section. I'll get Lyn to weigh in if possible. Okay, thanks all for tuning in.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.